Here's something most new LLC owners never find out until it's too late. The IRS doesn't care how hard you worked, they care how you paid yourself. And if you're doing it wrong right now, and statistically over 60% of small business owners are, you could be leaving thousands of dollars on the table every single year. Not because your business isn't profitable, but because you chose the wrong payment method. Today, we are fixing that. We break down LLCs, legal strategies, and business finances in a way that actually makes sense. No law degree required, no accounting background needed. In the next 8 minutes, you're going to learn exactly how to pay yourself as an LLC owner, the real difference between a salary and a distribution, which one is right for your situation, and how to set it up without making the mistake that costs most entrepreneurs thousands every tax season. If that sounds good, let's get into it. The mistake LLC owners make. Let's start with the mistake. You open your LLC, business starts coming in. You need money for rent, groceries, life, so you do what feels natural. You transfer money from your business account to your personal account and you call it your paycheck. Simple, done. Right, wrong. That transfer wasn't just a transaction, it was a tax event. And depending on how your LLC is taxed, doing it incorrectly can mean you either overpay in self-employment taxes or worse, you trigger IRS scrutiny for paying yourself unreasonably. Here's what you need to understand first. An LLC is not a corporation. By default, it doesn't have a formal salary structure. The IRS actually calls LLC owners members, not employees. And that one distinction changes everything about how you get paid. So let's break down the two main ways LLC owners can legally pay themselves. Owner's draw distribution. The first method is called an owner's draw, sometimes called a distribution. Think of it this way, your LLC made money. That money sits in the business. When you take some of it out for yourself, that's a draw. You're not paying yourself a salary. You're simply pulling profit out of the business. This is the default method for most LLC owners, especially single member LLCs, and it's completely legal and normal. Here's how it works. Your LLC earns revenue. After expenses, whatever is left is considered profit. You can draw from that profit whenever you need to. There's no set schedule, no withholding, no payroll taxes deducted at the time of the transfer. But, and this is important, the IRS still gets their cut. As a single member LLC, you're considered a sole proprietor for tax purposes by default. That means all of your business profit, whether you draw it or not, is reported on your personal tax return using a Schedule C, and you'll pay self-employment tax on all of it, which is currently 15.3% on top of your regular income tax. So taking a draw is flexible, it's simple, but it doesn't automatically save you money. That's where the second option, and a specific tax election, changes the game. Salary. When does it apply? The second method is paying yourself a formal salary. Now, for a standard LLC taxed as a sole proprietorship or partnership, you actually cannot pay yourself a traditional W-2 salary. You are not an employee of your own LLC by default. The IRS doesn't allow it. But here's where it gets interesting. If your LLC makes a specific tax election, you can change that entirely. That election is called an S-Corporation election, and it is one of the most powerful tax strategies available to small business owners. When your LLC elects S-Corp status, the rules change. Now you are required to pay yourself a reasonable salary through payroll. You become a W-2 employee of your own company. The salary is subject to payroll taxes, Social Security, and Medicare, just like any regular job. But here's the twist that makes this worth it. After you pay yourself that salary, any remaining profit can be taken out as a distribution, and that distribution is not subject to self-employment tax. Let me say that again, because this is where the money is. Your salary gets taxed. Your distributions do not, at least not with self-employment tax. So if your LLC nets $150,000 and you pay yourself a reasonable salary of $60,000, you only pay self-employment tax on that $60,000. The other $90,000 comes out as a distribution. That's potentially $13,000 plus in tax savings every single year. Single member versus multi-member LLC. Now let's talk about how this changes depending on your LLC structure. Single member LLC. By default, you're taxed as a sole proprietor. 100% of profits flow to your personal return. You can take draws freely, no formality required, no payroll needed, but you pay self-employment tax on everything. Multi-member LLC. By default, you're taxed as a partnership. Each member pays tax on their share of profits, even if the money stays in the business. Distributions should be proportional to ownership, unless your operating agreement says otherwise. This is why having a solid operating agreement is non-negotiable for multi-member LLCs. Services like Northwest Registered Agent and Zen Business can help you draft and formalize that operating agreement when you set up your LLC, and trust me, you don't want to skip it, especially if you have a business partner. In both cases, single or multi-member, if the business grows and starts generating consistent profit above $40,000 to $50,000 a year, it's worth seriously considering that S-Corp election we talked about, the S-Corp salary trick. Let's talk about how to actually do this the right way. To elect S-Corp status, your LLC needs to file IRS Form 2553. There are eligibility requirements. You need to be a US citizen or resident, have fewer than 100 shareholders or members, and only one class of stock. Most small LLCs qualify easily. Once you're an S-Corp for tax purposes, here's your action plan. Step 1. Set a reasonable salary. The IRS watches this closely. Reasonable means what someone in your role would be paid on the open market. Don't try to pay yourself $1 a year to avoid taxes. That's a red flag. Use industry benchmarks. If you're a solo web designer charging $200/hour, a reasonable salary might be $60,000 to $80,000. Step 2. Set up payroll. Yes, actual payroll. You'll need to withhold income taxes, Social Security, and Medicare from your own paycheck. Tools like Gusto or QuickBooks Payroll handle this automatically. It costs a little, but the tax savings far outweigh it. Step 3. Take the rest as a distribution. After payroll, remaining profits can be withdrawn as distributions, tax efficient and fully legal. Step 4. Work with a CPA or a legal service to make sure everything is documented. Platforms like Rocket Lawyer or Harbor Compliance are excellent for keeping your business legally compliant as you grow. LegalZoom and Taylor Brands also offer business advisory tools that can guide you through elections and compliance. And if you're just getting started, if you haven't even formed your LLC yet, Swift Filings Inc. Authority and Breezy are great services to explore for forming your LLC fast, affordably, and with built-in guidance. Alright, let's pull this all together. If you're a new LLC owner just starting out, take owner's draws, keep it simple, focus on growing the business. If you're consistently netting $50,000 or more in profit, start having the S-Corp conversation with a tax professional. The math almost always works in your favor. If you have a business partner, get your operating agreement buttoned up now, not later. Disputes over distributions are one of the top reasons LLCs collapse. And no matter what stage you're at, keep your business and personal finances completely separate. That means a dedicated business bank account, clean bookkeeping, and documented draws or payroll. This isn't just good financial hygiene, it protects your limited liability status, which is the whole reason you formed an LLC in the first place. The bottom line, how you pay yourself is a strategy, not an afterthought. Most business owners treat it like an afterthought, and it costs them. You now know better. If you found this video helpful, hit that like button. It genuinely helps more entrepreneurs find this content. Subscribe if you want more videos like this on LLCs, legal strategies, and building a business that works for you. And drop a comment below. Are you currently taking draws or are you on payroll? I rate every single one. I'll see you in the next one.